Hey everybody, thank you for watching. My name is Peter White. I work for a company called Enjine, and we build custom investment software for quants. But our real passion is machine learning. And I'm here today to give you just a little glimpse into how machine learning techniques can help investors achieve their full potential. And I will be doing that by showing you a portfolio optimization technique called Hierarchical Risk Parity. I will be calling it HRP for the rest of this video, because the over-under on the amount of times I can say hierarchical correctly is about 2, so I don't want to push it. Now, HRP uses machine learning techniques, and it's always a little odd to talk about machine learning because people have such vastly different ideas on what it is. I mean, some people have no clue whatsoever, and then some people think it's cyborgs and robots and time travel and stuff, and they're going to be a little bit disappointed. Because for our sake, machine learning is just kind of an advanced type of software. It's like the next evolution in software. It's code that can learn from data on its own without us interfering. So it's a little bit disappointing if you thought it was time travel, but it's an incredibly powerful technique. Now, as I mentioned, HRP is a portfolio optimization technique. But why do we even care about portfolio optimization? The answer may seem kind of glib, but it's true. It's because it's hard to beat the market. I mean, we've all seen the studies. I just read one that said only 8% of active managers can beat the market over a 10-year period. That's incredible. And I'm not saying that number is 100% accurate, but if it's even in the ballpark, that is staggering. So why is it so hard? I mean, you'd think it'd be easier now more than ever. There's more data and tools available than ever before, but somehow it's even harder. Why? I mean, one of the big answers is discipline, if we're honest with ourselves. I mean, investing money is a lot like losing weight. Something I'm familiar with. I don't know if you can tell this on the video or not, but I'm kind of fat. Not like really fat, but like fat enough. So every couple years, I try to lose weight. And every couple of years, I fail. And if I'm honest with you, I know why. It's because whenever I go to lose weight, I spend way too much time on exercise and not nearly enough time on diet. Because exercise is the part that makes you feel like you're doing something. You're out there, you're sweating, you can feel the weight melting off you. You feel like if you go to the gym enough, it doesn't really matter what you eat because you're putting in so much effort. So that's what I do. I put in so much exercise, and I kind of pay attention to my diet, but not really. And then 3 months later, I'm staring in the mirror going, why the hell am I still so fat? And a lot of us do the same with investing. We spend all our time and energy on security selection, and we don't spend nearly enough time on asset allocation. Because security selection is the fun part. You're out there, you're doing something, you're picking winners. The allocation doesn't matter so much as long as all the stocks you pick are winners. That's how we all think. And then 3 months later, we're all staring at our accounts going, why am I still so poor? Deep down, I know that if I spent as much time on my diet as I did on my exercise, I'd lose weight easy. And we all know that if we spent as much time on asset allocation as we did on security selection, we'd see a lot better performance. I mean, we all know that a well-maintained, well-diversified, well-cared-for portfolio of average assets can easily outperform a poorly maintained, poorly diversified set of better securities. That's just a fact. This isn't just me coming up with this. There's tons of research out there to support it. For instance, a recent study put out by Resolve Management, a boutique firm out of Toronto with about 200 million AUM, according to their research, once market returns are removed, asset allocation and security selection account for equal measures of quarterly returns. So if portfolio optimization is so important, how do we do it? I mean, to really understand that, we have to understand the history of investing. As we all know, investing was invented in 1305 by Johannes Stockton, when he would literally sow money into the vests and then give them to sea captains of ships that he wanted to support. And that's how we get the term investing, at least according to a Wikipedia article that I wrote to make this video, because who cares where investing came from? That's not important to us at all. The history of investing is irrelevant. Someone started giving companies money, blah, 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 Amsterdam Stock Exchange, yada, 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 Great Depression, 1950. That's kind of where we start. You see, prior to 1950, portfolio optimization was way more art than it was science. People optimized with their heart, not with their brain. But that started to change with Dr. Harry Markowitz, Nobel Prize winner and one of people's sexiest men alive. Markowitz created a beautiful mathematical formula called modern portfolio theory. You've probably heard the name before, you may have even seen this graph before. This is something called the efficient frontier. By comparing expected returns to variance, Markowitz was able to create this beautiful curve. And essentially what it says is if you plot your portfolio and you're not on the edge of that curve, you can do better. You can either expect more returns for the same risk, or you can lower your risk and get the same returns. It's an absolutely beautiful theory. So why isn't it really in use today? Well, because it's brilliant the same way that the Wright brothers' plane was brilliant. I mean, it's an incredible breakthrough, but it's not really practical to use in everyday life. Markowitz's theory has a few glaring flaws. The first of which is that you're required to guess the expected returns. You have to estimate them before you can even start your calculation, and that is not an easy thing to do. If you could guess expected returns perfectly, you wouldn't need this formula. You just pick the returns, stocks with the best returns, and you'd be rich. But obviously that's not an easy thing to do, so that introduces a huge amount of error into the whole calculation. And beyond that, there's a bit of a mathematical issue. I won't torture you with the details, but in order to complete the calculation, you have to do something called inverting the covariance matrix. Now, I know that sounds like a Harry Potter spell, but it's not. It's a mathematical method, which is very solid, but the problem is, as matrices get bigger and bigger, it becomes more and more complicated to take the inverse. It becomes very unstable, to the point that a small change in variance can lead to a huge change in your weights. Obviously, that's not ideal. You can even end up with weirdly irrational portfolios. The routine will tell you to sell everything and put all your money into one security. That's not an optimization routine. That's a drunk client. But obviously, the work of Markowitz was so brilliant that people have been trying to build on it ever since. The idea is solid. There must be a way to perfect it. So since then, people have been taking stabs at it. One of the first and most important was the Black-Litterman model, created by, obviously, Black and Litterman. The Black-Litterman model tried to improve on some of the issues that Markowitz had. The big breakthrough was to change the need for the expected returns. Black-Litterman doesn't require you to take a stab at it. Black-Litterman uses past price history to create a market-neutral point to start from. And then on top of that, the user can kind of adjust that based on their prediction for the stock. This created a huge improvement in results. Getting rid of that expected returns gets rid of a lot of the uncertainty, and we're able to calculate a lot more accurate portfolios. However, the mathematics behind the thing is still the exact same as Markowitz. You still have to invert that covariance matrix, and you still run into all the problems that come with that. So while it's an improvement, there's still a long way to go. The next big breakthrough in optimization was less of a nuts and bolts change, and more of a philosophical difference. For lack of a better term, it was a paradigm shift from how we viewed things before. Up until this point, portfolios were always diversified across capital. You would say, all right, I'll take 60% of my money, I'll put that in stocks. I'll take the other 40% of my money, I'll put that in bonds, and I'm safe. But what risk parity would say is that, hold on, that's not actually diversified. Because if you look at it through the lens of risk, 90% of your risk is in your stock, and only 10% is in your bonds. Which makes sense. You put 40% of your money in bonds, you have a pretty good idea what you're going to get at the end of the day out of that. All of your uncertainty is in your stocks. So what risk parity would say is, instead of dividing capital 60-40, why don't we divide risk 50-50? Why don't I put 50% of my risk into stocks, 50% of my risk into bonds, and then I have a much clearer picture of what my returns are going to look like. And you may be concerned that those returns are going to be a little bit lower than maybe they would be with the stocks, but by using leverage, we can really change that to the point that we can expect the same return for substantially less risk. It really is a complete change of how we tackle the problem. However, as with Black-Litterman, the underlying math is still the same as Markowitz. We still have to invert that nasty covariance matrix, and we're still going to run into all the issues we had before. Irrational portfolios, weird weightings, easy to change. We're still not quite there yet. That leads us to HRP. HRP was developed a couple of years ago by Dr. Marcos Lopez de Prada, Quant of the Year 2019, which is a title I really hope comes with a giant championship belt. The driving force behind HRP is that assets are grouped together by, for lack of a better term, sameness. The idea is that if two assets behave the exact same, they shouldn't each get their own slice of the pie. They should be competing over the same slice, because they're essentially the same. It's like this. Say you were training for a decathlon. All right, 10 events. You're trying to find the optimal way to get prepared. You could say, hey, I got 5 hours a day, there's 10 events, I'll do a half hour on each one. That seems fair. But what HRP would say is, hold on a second, you might not want to divvy it up that way, because I've noticed that the 100-meter sprint is an awful lot like the 400-meter sprint. So why don't I lump those together and call that running? That'll compete for a section. And also, hey, the The 110 meter hurdles is pretty similar too. It's just sprinting with a little jump in it. Maybe I can lump that into that group. We can call that the running training. And that'll compete alongside pole vault or shot put. And it gives us a structure to kind of divvy out our timing a little better. HRP does the same thing, but with assets. And it does it in a beautiful way, by not inverting the covariance matrix. That's right, all the trouble we've talked about the whole time is gone. Instead of inverting that covariance matrix, what HRP does is uses some mathematical tricks to convert the distance into physical geometric distance. That allows us to have a better idea of how similar these assets are. Then what we can do is we can start grouping them. We find the two that are closest together, we say, hey, we're going to treat you as one. So that's one thing. Then we go, all right, what are the next two closest assets? We lump those together, and we keep lumping things together 2 by 2 until we have what's called a binary tree, which you can see right here. This structure allows us to divvy up the allocations a lot easier. Once we have this tree structure, we're ready to start calculating allocations. Basically what we do is we start at the top of the tree. We know at this point there has to be 100% of our allocations there, because all of our securities are in it. And we go down and we just start breaking things up. At the first break, we have some of our securities on the left, some of it on the right. Through some math, what we do is we calculate which percent's going to go to the left, what percent's going to go to the right. So let's say, 60% of our allocation is going to go to the left branch, 40% to the right. All we do then is we do the same thing, but keep following it down all the way to the bottom. So 60% on the right, we go down to our next break, say 60% goes to the right of that, 40% to the right of that. We just keep working our way all the way down to the tree until we have all of our allocations at the bottom. Now obviously that's kind of a high-level overview of how HRP works. The nuts and bolts are a little more complicated than that, but the premise is that allocation is based not just on risk, but also on sameness of investments. This ensures that across all asset classes, you are diversified in the most responsible way possible. Now I'm not going to stand here and tell you that HRP is perfect. Obviously no portfolio optimization method is 100% perfect. For instance, the bisection method used in HRP is a little bit inelegant and can sometimes lead to heavily correlated securities being put in different groups, which is not ideal. And if the whole portfolio is heavily correlated, the results out of sample can be a little disappointing. All that said, HRP is a cutting-edge technique that performs beautifully out of sample. It may not be perfect, but it's a great way to ensure that you are properly diversified and protected in as many situations as possible. The reason we at Enjine got interested in HRP is because it employs some very sophisticated machine learning techniques. I know it may not have seemed that way from the description I just gave you, but trust me, none of this is possible without machine learning. And I think it's important to say that so that people understand that machine learning isn't always something dramatic. It's not always robots and self-driving cars. Sometimes it's as simple as doing the math to help your portfolio be protected and diversified. Now, as much as we love HRP, it's not really a catch-all solution. Optimization doesn't really work that way. Portfolios are kind of like cats. You can't really use the same approach every time. You have to do the research and investigate and figure out which portfolio optimization method is right for your situation. And listen, I know you don't want to do that. I know that sounds a bit tedious. You'd probably rather rip your eyeballs out than sit down and go through all the different optimization methods. And listen, us too. So that's why we've created this open source library that does all the work for us. This Monte Carlo optimization simulator is based on a 2019 paper by the aforementioned Dr. Lopez de Prada, and it allows you to kick the tires on a bunch of different optimization methods at once to see which one is right for you. The basic idea is that optimal allocations are computed for a set of optimizers based on the known covariance and expected returns of your portfolio. The system then creates a large number of realistic simulated expected returns and covariances from the originals. Allocations are then computed for these simulations, giving us a lot of data to work with. By comparing our simulation results to the true optimal allocations, we can determine the average performance decay in terms of expected outcomes, mean difference in variance, or the mean difference in Sharpe ratios. As you can see from this Jupyter notebook, with very minimal effort, we are able to get a detailed comparison of different optimizers across several metrics. By comparing and contrasting the results of the different optimizers, we are able to be certain that we are using the right solution for our needs. Shouldn't you do the same?